Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, July 15th, 2022. It is exactly 2:30 p.m. as I'm starting the video, so an hour and a half left to go in the trading day and in the trading week. So what I'll do is a brief update on the equity markets. So far, so good. Continue to add just additional check marks to my bullish stance. And for those just catching up, what I'm referring to is the day the market bottomed. That was when QQQ hit my third price target on the weekly charts. Those are my primary swing slash trend targets, and that was a big one. So I went on to say that that level was time to start covering short positions and start to scale into longs. And I said that was clearly my preference at the time, and that I put favorable odds that we get a swing tradable rally. That doesn't mean a day, 2 days. It means weeks and measured in usually double-digit percentage terms in the market. So that was it. Covered all shorts and started to go back into longs. And then I said if we get some additional buy signals, which of course we got after that, then I would add to those positions. So that brings us up to today. So let's take a look at the charts. And so the additional check mark is, we've rallied here. There's a downtrend line that's formed on, I'm sorry, an uptrend line that's formed on QQQ. Same one I've covered for a while. We hit it the other day and we've rallied off it. Now, of course, I still want to see and need to see these highs get taken out. I expect that'll be the case. Fundamentally, everything's falling into place. I dug a little deeper and read through Jamie Dimon's comments yesterday. I talked about J.P. Morgan. They missed earnings by a large margin. Stock got knocked down hard. I told you it was a buy at support. Well, that's up today. So if you took that, congrats to you. You're doing good, and I think there's more to come. It's up another 5% today. So if you grabbed it on that earnings smackdown yesterday, you're up in a day over 6.5%. Remember, it was just not a random call. It was down to long-term support, about the 105 level right there with positive divergence. And so far they're gobbling up. Now what Diamond said is, what a big part of it was they would put additional funds aside for loss reserves, expecting that, hey, we're good chance we're going to head into a recession. But as of now, they're not seeing it. The only weakness they're seeing is their low-end consumers, bankers, people that have very modest means that are with the bank. But most of the people that bank with J.P. Morgan Chase are more affluent, and they say those customers, by all their metrics, are doing fine. Businesses are doing fine. As of now. So again, it's what I've been talking about. Maybe it continues to pan out, maybe not, but I think we're going to see a paradigm shift. Consumer spending beat today. This morning, the numbers came in. Let me grab that for you. I've got another retail sales, that is. They rose 1% in June. Shoppers boosting retail sales. And so that helped also with the rally today. And then, of course, we have all the other big banks out of the way today as well. I told you J.P. Morgan's the largest. They reported yesterday, and they're gobbling it up today. Bank of America reported today, up 8%. Wells Fargo, another big one, up almost 7%. And again, it's just not random. They all hit support with positive divergence. And now that one's at a trend line. So like I said, the financials aren't my favorite sector. But let's talk on that real quick. What I've, since reversing the day of the lows, from short to long, what I also have maintained very consistently and persistently is that I favored QQQ, the NASDAQ 100, over the other indexes. And this is a comparison. You can see right here, the black line, this is the black line, and this is the day they bottomed. This is the 16th, the day of my pivot there. And you can see that the NASDAQ 100 QQQ has clearly outperformed. This is IWM in green right here, which, by the way, I shifted some money into today. I think they're going to play catch up now, a little bit, the small caps. And the blue is the S&P 500. And the pinkish line here, that's the Dow. And that's, again, measuring them all from that same point. I set them to go off the low there. So that's that. And, that's it. The charts, again, nothing's changed. The charts were and continue to remain constructive on those market-leading FANG stocks. This is Apple right here. Divergent low at that low on the 16th. and went on to get some check marks of the breakout and a back test of the primary trend line right here. I mean, that's just textbook 101, at least my trading style. You can get a downtrend line, positive divergence forms a falling wedge pattern, a breakout, back test one, back test two, and we're moving higher, and it continues to make higher highs and higher lows. And if you're going to watch just one stock in the market, if that is all you could watch, that would be the one you want to watch. That's the largest component by far of the NASDAQ 100 and S&P 500, and the rest continue to remain off of those lows. That was a low for not just the stock market, but for all these market-leading FANG stocks. Amazon's perking up today, up 4.2%. And again, pretty powerful pattern. So let's not beat a dead horse. No change in the posture or my outlook. That is again, we'll certainly next check marks will come. We take out these highs, but on a shorter term time frame, I told you guys I trade off the 5-minute charts quite often. Today was a great trading day. We gapped up, and this, I can't remember which video. I from time to time I touch on this one. I know within the last week I shared it. And all these levels, I believe, all the levels you're looking at, maybe other than one of the lower levels right here, these were all on here, including this 291.23. So it was a great trading up. We gapped up, rallied, hit it. I was able to reverse, short, cover, and pull back to exactly where I figured that was that support line. All these lines were in place before today, and rallied up again, and have been trading on that level right there, and I think it's going to pop. See, we already had two rejections, one that took us back to support, the others keep getting bought up shallower and shallower. And what this tells me, again, I try to, look at the charts, but I also try to give you my insight, and I try to figure the inside of everyone else's minds. It's, like the art of war. You have to know thyself and know thy enemy. And, thy enemy is those that are against your position. So what I'm seeing are probably a lot of shorts that now are starting to get that paradigm shift I talked about, saying, hey, wow, recession was like 100% probability, and it wasn't a matter of if we're going to have one, it's how bad it's going to be, and the stock market was going to go a lot lower. But all of a sudden, you continue to hear what I've been saying, talk to people, going on vacation, every vacation spot's full, hotels are full, restaurants are full. Heathrow had to shut down because they're too busy, right now with flights coming in and out. So I told you, it's not yesteryear's recession. This time is going to be different, and it has been different so far. And the most important thing, the consumer is holding up. Let's just not overanalyze this. Consumer spending accounts for 2/3 of GDP. The Fed's been raising rates. I've already showed you there's been a drastic abatement in commodities over the last month that was not even remotely reflected in the antiquated and lagging CPI numbers, and that's all I see and hear in the media. And again, that unless there's a huge rally from here, and again, I'm trading bounces and all that, but we'd have to get back up to where we were before, and that's a long way ahead. And again, if you're just catching up or new to the site, I use DJP. Is it is my my primary in real-time inflation trackers, because it's a very diversified, broad-based commodity index. And this is it. This is the drop we've had, and it has oil, natural gas, agriculture commodities, industrial metals, precious metals, you name it. It's all in there. Very well diversified, and it's down 23%. And by my accounts, it's coming down more before all said and done, at least to this level there. Sure, we can have a bounce before we get down there, but you'd have to have a heck of a rally now just to get back where we were. And so at that point, there's no acceleration or increase in inflation. Again, I know that commodities aren't the only thing in there, but they're a big part of it. Food prices, energy, big part of it. Of course, you have shelter, which is housing, and things like, and services, and that's not counted in here. And services, I'm sure, run a little hot with, like I said, everybody's spending money and going to vacations and restaurants right now. But until the consumer really tucks in the shell in reality, because again, and this is where I think so many people are getting it wrong. They confuse rhetoric with actions. Everyone's crying the bear cry, crying the recession cry. But they're still out there, by most metrics, still, spending money. The consumer hasn't completely tucked in their shell. They may have pulled back a little bit, absolutely, sure. And that's how much of that's reflected so far in this 33% drop in the Nasdaq 100. So that's it. So as of now, looking good. And we'll take it day by day. This will probably be my last video for today. I'm going to cut out early, go get some things done. But again, look, it's Friday. Will there be some profit taken? Maybe, but on the flip side, will there be some short covering? Yeah. So I told you I'm kind of more in at least in my, especially my long-term accounts, swing trade mode. I don't want to sound contradictory. My active trading account all day long, I'll trade rips and dips to get a breakout here. That'll be a next buy signal. Whether we get a decent pullback or not. And if we do, there's the levels, 288.21, and then an even bigger support level, or as big, I should say, about 286.85 right there. Big old top of the gap right there. And it's, again, a line that I've had here because there are multiple reactions, including gaps and things in there as well. So I don't think we're going to go back that far now. I think we're starting to get that paradigm shift or point of recognition again for all those trapped shorts. I know pessimism's been high, and let's just microanalyze this one here. This is a crowd favorite. I've been reading about this. It's always been around. I've given trade ideas. SQQQ. You want to juice up your returns. Use leverage on an ETF. You can do you can do a one-time short on the Qs. That's PSQ. You can do a two-time, which is QID, or a three-time. You pick your leverage. It's like a Baskin Robbins 31 or whatever flavors. Go in and choose whatever flavor you want, especially on the broad-based indexes. But where I'm going with this, I know this one's been popular because they say all those retail traders that armchair investors, new to investing, the millennials, they all started getting involved towards the tail end of the bull market, which is usually the case, and they all opened up their Robinhood accounts and what are the other ones, those online apps, free trading apps on the phone, and they said those accounts have been blown up. They were buying Bitcoin, they were buying AMC and GameStop, and again, this is not just my opinion, I've read on this. A lot of those traders, their accounts have been decimated. So what they said, they've been using more and more going to leverage to try to eke out the maximum returns because their account balance is a lot smaller, trying to claw back their losses. So let's try to get in those mindsets. We know everyone's been bearish recently. So if we look at this just in the last few weeks, here was the market bottom right here. Remember, SQQ is going to be QQQ in reverse, except with three-time leverage. But there's the bottom and of the market. And you can see just going back for the last, this is the beginning of June right here. So last month and a half or so, if you look at the volume at price histogram, it tells you where all or the majority of shares of QQQ were traded. So we're going to assume, because we're in a bear market, it was dropping a lot of these were buy orders. And you can see this thin zone right here. Thin zone's comparable, not exactly the same, but similar to a gap. There's a big old thin zone. And that means a lot of people piloted SQQ right there. And so therefore it stands to reason there's probably quite a bit of stops in that range if that gets taken out. And then the last bit of them right there, there's a whole bunch there. And if that gets taken out, then that's going to be even more bullish for the stock market because you're probably going to have people selling SQQ, which in turn buys the Qs. If this ETF is getting outflows from SQQQ, that's analogous to inflows into QQQ. And so that's what you want to watch for, among other things. But again, it's not mere coincidence. It meshes with the levels that I've been giving you on the charts. There's the previous reaction low in SQQQ, which is simply flip it around. It's the previous reaction high in QQQ. Okay, that's it. And there's another thing that could spur. It could also cause a rejection if hit, a reversal, but also a breakout if taken out, and that's this potential downtrend line right here. This is a 15-minute chart, so that one comes off. Looks like right around early June right there, and that would be it's a little different. So I'm going to put it here on the 60-minute chart so we remember that. So I remember that if nothing else next week. And there it is. There's a potential trend line right there, minor trend line. That primary trend line's already been taken out right here, the yellow one, and back tested. So that's it. Let's end it here. Check mark if and when that's taken out with conviction. Conviction means, an impulsive move or a solid 60-minute close above. And then, of course, that previous high, which is also this pretty much almost a double top there. and about we'll call it 297 or so. And then that would bring us up to what has been since the day of the lows, my swing target, what I'm calling my initial swing target, about 305 there. And then I'm also very much open to the possibility and even leaning that way now that we're going to continue higher than that, maybe up to this downtrend line and one or both the 200-day moving averages on the daily chart, the 200-day exponential and simple up there, which still gives us if hit, about another 15% from where we are, and that's in addition to the, I don't know, whatever it is, 10% or so we've already climbed. Okay, so we know the JP Morgan trade idea. If you took that yesterday, you're make a quick buck. You want to get out 6-7% and run, great. One day, there's something I make a lot of stuff up in trading, a lot of terms, and one of them I call is velocity. And I define velocity as, if you get 6%, let's just say you did it once a month, or pick a round number, 10% on a trade, and you did that just once a month, and then you just sat back, waited patiently for the next setup, and you did it each and every month. You're talking 120% non-compounded return. Now, of course, that would be compounded if you kept, plowing back the profits into that and got 10 on the next one, and then you're talking well over, you compound 10% on a monthly basis. You're well over 120% a year. Now, you're not going to win them all, of course. I'm not trying to say you've been about 1,000, but again, there's something to be said about taking the quick money and running there, or define your trading style. I made a case that the financials have hit some long-term support, positive divergence on the stock market, on the market-leading fangs, and could very, very well just sit tight and set stops below where you bought it yesterday around the lows, and let it run. And then the other trade idea I gave you yesterday was Shake Shack, and that's SHAK. Oh, no, I typed it wrong. SHAK, there it is. Boom, hit the first target almost to the button today. The high was $47, 46.90. And the typical reaction, that's you hit that level, and we've been consolidating there. This is right here. This is a 1-minute chart. So you hit it, a little bit of pullback, but mostly consolidation. I still favor this one heading up to that next target there, and so got it out to you not right after the breakup, but I used the where I got it out to you as a calculation. I think what I come up with was a little rounded off to about 7% gain so far, and that would get us up there, and that'd be about 35% of hit. So the pot stocks, remember the one I gave you yesterday was only a setup. I'm trying to recall which one. There were several I covered in the video that I know it didn't get out to you till late last night. A little snafu. I thought I published it yesterday before the close, but we're still waiting. We need to follow up on those above those levels I gave you yesterday. A lot of them had rallied into resistance, and so far no confirmation on the bullish engulfing on CGC, OGI. Right there, still work to be done. And the one that I gave you, goodness, that was GRGW. Let me type that in here, GRGW. And that one hasn't broken out yet, I don't believe. GRGW. Did that wrong. GRWG. Okay. I should have had it in front of me, and I didn't. So that one still needs to break. See, R1, resistance 1. So boom, we'll be looking for that next week. So I've got a price alert to tell me when that one breaks out. And then just an update here, because this continues to reinforce my ongoing theory that the market was wrong the other day in reading that hot inflation number, that even the pros are wrong betting. Remember, they immediately ramped up the the probability of a 1% hike to 75%, over 75%, with down to about 25% on the 3/4 point. And now look at this. This continues to fall. So remember, I faded that trade. Told you I covered it yesterday, shorting that chance of a 1% or going long, which pretty much was a bet that we'd fall back down. And now you can see we're almost at 70% back to a 3/4% hike and only a 30% chance of a 1% hike, which goes to show that, hey, it took a little time, and then they're realizing, okay, well, Maybe the Fed isn't going to give us that 1%. And more so, even whether we get the one or not, it's still on the table. I think you're going to probably hear them recognize that they're seeing some signs that their rate hikes are working. That's what my theory is all about here. Believe me, still a long-term bear. I'm just a near-term bull again because everyone got too crowded on one side of the trade, too much talk of a big recession and more downside in the market. And you know what happens. The problem with the stock market or any trade, when everyone's thinking the same thing, that thing doesn't happen. That's the problem with it. And so that's what sentiment surveys and on all that stuff and being contrarian are all about. So hey, all right, that's it. That's my case. And here's the good thing about trading for me. I'm not married to any one thing. I will throw a trade away in a heart shake. I'm sorry, in a heartbeat. I was about to say two shakes of a lamb's tail. I had a old great aunt that used to say that one, so I got those two mixed up. Um, so with that reversal in the chance from a 1% rate hike from the Fed back down to three quarter, what you're seeing is some strength, at least in the last couple of days, because of that in the euro. Remember, the higher the U.S. rates go against European rates, the ECB, the stronger the dollar, and vice versa, and that's also going to affect the metals trade. So far, this is playing out. And if we get to the point where Jay Powell and company says something after the next meeting that implies that they think they've done enough for now and they're going to sit back and assess and wait and see, then boy, you could really see a nice rally here. I'm going to talk about one other kind of little scenario that's been just bouncing around the back of my head lately, also on crude natural gas, and I'll get to the natural gas trade in a second. That one's kind of pushing the limits of where it should have bounced to right now. But only other one I'll mention here is I try to think catalysts for the markets, and if we're going to have what could be would it be an outright explosive rally? Probability is very small, so don't think of me as a conspiracy theorist. But I'm thinking, here's what's keeping oil and natural gas prices elevated. We've already surprisingly seen, or maybe not so surprisingly, wheat and some other things come down that were part of that whole Ukraine-Russia trade. Things that come out of there, like platinum, palladium, wheat. Ukraine being a big producer, and Russia of all the above. So I'll just say this: if at any point in time, and at least in modern history, there was a chance of an assassination of a world leader, it would have to be now. If you think of the pressure, these are major countries. Let's just talk Germany. Germany is at risk now of getting their lifeblood choked off with natural gas. France, think about what happened in France. Or I'm sorry, Italy. You have Mario Draghi resigning, stepping down completely over the whole disagreement in his party with internal politics with supporting the war efforts in Ukraine against Russia. I mean, this thing goes to the highest level. There's never, and not even close, since probably World War II, has there been such pressure on these developed European countries. And it's not Russia. It's one man. It's Putin. This is Putin's war. And look, I know the guy's probably orchestrated more assassinations than just about any other world leader alive today. So he knows the drill, ex-KGB and all that. And maybe not. But if that were to happen, and that would probably effectively end the occupation of the war against Ukraine, and you would have nothing short of an explosion in the stock. Oil prices would probably crater, along with natural gas prices. And so all I'm laying out here, look, the probability is next to nil. There's not many high-level world leaders that have been assassinated. I know that, we had, Abe, ex Japan Prime Minister recently shot, but that was he wasn't active anymore. So the odds are very small. But what you have to calculate is the risk reward. So, and look, it goes the other way. That situation over there could escalate, but the only way, other than just a much larger, offensive from Russia against Ukraine, or maybe just some other some errant missile flying and hitting, landing into another country, bordering country, or someone else getting killed. Thoughts of nuclear, Russia or Putin going nuclear, and that's slim to none. So, anyways, I know I'm rambling here, but I'm trying to tell you that is one thing to be aware of, especially if going long things like natural gas and crude oil right now. Because again, if there ever was a time in modern history that we've had some of the most powerful countries, just about all of them, the big ones, G7, you name it, wanting one man out of power, and including, not to mention, all the people within his country, of course, as you guys, I'm sure you read about. So, all right, I just wanted to throw that out there, and if it happens, boy, react, jump on it. Don't, if you would see crude crater, probably lock limit down on futures, but if you could get on that short, if that happens, then that's what you'd want to do, and stock markets would go crazy to the upside. Okay, so again, tiny probability, but infinitely higher than at any point in modern history, I think, of that happening, or some iteration of maybe an attack that wounds them or something like that. All right, so that's it. So the euro, as of now, with the Fed, chance of a 1% rate now, all the way back down to what was it, 30% or so, from 0.75% the other day, or 75%. That's caused the euro to come up, and that should put a tailwind under the metals. We're still not seeing what I wanted to see on GDX. But it doesn't matter if the euro goes up and the dollar continues to fall. If that's the beginning of a trend, absolutely gold and silver will follow. The charts are still constructive, so there's no. Well, here's the thing: we have still the potential for a island cluster bottom. There's our island cluster. Remember, yesterday it was one candle. If you have multiple candles and then you get a gap up, then that is the island cluster bottom reversal pattern. So you'd want to see that. And then at that point, it's real simple. It's one of my favorite patterns to trade. If you get it, you go long. You don't have to wait for a confirming candle. You can just put a stop. I like to get a little room because this market's plagued with. In the old days, I used to put the stop just below the top of those previous candles, because if the gap is all the way backfilled and then some, then it's no longer a island cluster. It's not separated by a gap on both sides. But in this day and age, you almost have to count on the markets running. They know where the stops are. The big firms, they buy that information, they see it. Heck, they have it. If you have a Merrill Lynch account, Bank of America owns Merrill Lynch. They own their trading desk. They're going against it. It's why the commissions are free. They're looking at your order flow. They're selling your order flow. So anyways, they know where all that stuff is. So you got to plan for it. And that way you're talking small. If it's a bottoming pattern, and so if you took a gap up, you could give yourself, a 5%, 4 or 5% stop easy on that. And I think that's plenty, depending on how big the gap was, because you're looking for a reversal. Not a bounce trade, and a reversal that would be, if my third target zone's hit, a 25% gain and that's measured from a sizable gap up. So again, only a potential trade, just like that pot stock I gave you the other day. It's a setup, not an actionable trade. Actionable trades, let me just get to natural gas. Natural gas is pushing the upper ends of really where it should have gone. We did an update today. We hit the bottom of that first target zone. That was 604 down to about 323. Hit that. I gave you this, added these blue trend lines today, and then we had a resistance level. This is where I highlighted as an objective short back at 680, and we had 6897. So we'll call that 6900 or 6.900, roughly just above. We're a hair above it now. Not ideal, but if you look back here, and I'm going to take this, zoom in a little bit so you can see it. You could say that there is, I'll tell you there is resistance. It's not you could say. I'm not trying to force a level. There's a gap right there, right where my crosshairs are, and that's a candle on the gap down from the 17th to the 19th. All right, so that would have been a weekend gap right there. There's the gap. Then you came and backfilled the gap there. There's a reaction high there on the 21st, and that's where we're at now. So it's not the best resistance level, but it keeps this divergence still very much intact. So I'll tell you, most of you probably want to stop out, but and I have a feeling for those of you that bought cold, and I mentioned this 100 times, you have to adjust your position size down, especially to account for the leverage and the volatility in natural gas. You're probably feeling pain. I'm going to take this one home over the weekend. Yeah, it subjects me to an extra, some overnight risk. Um, Maybe on Sunday the futures will gap up, but there's big divergence. So I'm gonna give it a little room because I was able to reshort it there at 680. I wish I would have held off till now. I wouldn't even add at this point. I'll be honest. If you didn't take it, I would wait and see if you get a gap down because I don't like that it took out 680. But again, it's got big divergence right here on the 60-minute chart, and at minor, what I would call minor resistance right now. And I'll just leave it here with Bitcoin and Ethereum. Remember, they are what I'm at this point in time calling risk on, risk off trades. So far, the market's been rallying. And so basically, I think that if we can substantially build on this week's gains next week, take out those previous reaction highs, take out the next resistance levels overhead. In other words, get another 5+% rally. The more the better. That will most likely cause Bitcoin to break out here of that recent trading range and then run up and hit those pretty. I don't think they're aggressive. They're pretty minor targets, but in percentage terms, they're big. To that $18 level on GBTC, that's 33%. If it runs all the way up to the trend line, you're talking about 60%. But you're going to need to see, of course, they have to break out, and it's just going to help if the stock market rallies because it'll start bringing some of that risk-on trade back in sooner than later. We're already seeing it now with the small caps, which tend to be more of a volatile risk-on, risk-off trade for the indexes. They're playing catch-up today, outperforming. They're up, the Russell 2000 futures, RTY, are up 2% right now, with the NASDAQ up, futures up 1.5%, and ES up 1.7%. So we're seeing an appetite for risk come back in the market. They're gobbling up those bank stocks, like I said, that got beat down on earnings. Sometimes it just takes a day or so for the slower folks to read through and parse through all the information and kind of, I don't know, whatever. Like I said, I like buying when there's blood in the streets, and that's what we saw yesterday. And that's a typical kind of selling climax there when you have a big gap down and then a nice reversal, like on JP Morgan. The sell-off yesterday was on very high volume. I don't know if you can see my volume bar. It's right below that doji stick there. So that's it. All right, let me wrap it up here. Get the video out to you guys. Again, this will probably be my last one for the day. I'm going to run out to some errands. I got a barbecue to go to tonight. So unless there's any big fireworks before the close today in another hour or so, this will be the last video until next week. This has been Randy Finney with Right Side of the Chart. Have a great weekend.